Hi everybody, and welcome back to our last video. Here we're going to be looking at how we apply linkages to our four financial statements. Our financial statement, they use a big word here, articulation, and the connections are important to understand during the period as the balances change. Why? Because it points out there is an interconnection between how profits, cash flows, and the balance sheet interrelate to each other. And you have to know how that works to assess the potential of the transactions. All right, let's look. This is a lovely diagram, so let's take a look at this in a little more depth. Here, we're going to do these financial statements in a specific order. And the first one we're going to do is in the middle here at the income statement. You see it here? And this net income here of $59,531, we're going to see that come down here to the net income in retained earnings. So as I look at the statement of stockholders or shareholders' equity here, you can see that we start with our beginning contributed capital. We issued some stock, and we had a beginning or an ending statement of shareholders' equity here. Now, we're going to pick up retained earnings, which is just like I explained earlier. We're going to start with beginning retained earnings, add the net income that we just did from the income statement here, subtract out dividends, subtract out some other adjustments, and we have our ending retained earnings. So what do we do with that little jewel? Well, the ending contributed capital here is going to roll up here into the balance sheet, and the ending retained earnings is going to roll up here into the balance sheet. And lastly, our other stockholders' equity is going to roll up here into the balance sheet. So, our cash balance, note, is $25,913. Where did that come from? Well, it came from the transactions affecting the cash account, but you can see that this ties out to the statement of cash flows here at $25,913, same as the $25,913 here. And that's comprised, of course, of the operating cash flows, investing cash flows, financing cash flows, our net change in cash, our beginning cash balance, and our ending cash balance. So this balance sheet represents the beginning of the year, and during the year we had transactions affecting these three financial statements, and then at the end of the year we have our balance sheet that's adjusted. All right, now we're going to locate some additional financial information from public sources. And the SEC, for publicly traded companies in the United States, has the commonly known Form 10-K. The 10-K is the annual audited report. But there's also a 10-Q. It's not audited, but it's still very valuable, that comes out on a quarterly basis. The 20-F is for non-GAAP or IFRS, international companies' annual reports, and it provides a table that reconciles net income as reported to U.S. GAAP net income. Admittedly not used that often. And the 40F is the same as the 20F, except for Canadian companies. And then we have the 8K. Now, this is ones that we use for unusual situations. There's a wide range of corporate events that are sometimes reported or have to be reported within 4 days. If we have a bankruptcy, if we have a material definitive agreement, exit from a line of business, or impair some of our material impairment of assets, change in the company's certified public accountant firm, and a change in the control of the company, if any of the executive officers should leave the company, or a major change in the company's article of incorporation or bylaws. And some other information sources that we can use are from our equity analyst reports. Things like Moody's or other providers, the sell side analysts are going to provide the clients with some objective analysis of the company's activities, buy, sell, right? And this research is important. It attempts to forecast revenues and earnings per share and the stock price target. Now, earnings per share we haven't discussed, but it is the net income divided by the outstanding common stock shares. But it isn't quite that. We have to subtract from that net income preferred stock dividends, if there are any, because those preferred stock dividends are not available to common stockholders. And then, of course, we have credit reporting agencies. Dun & Bradstreet is a good example. We rate these credit rating agencies provide objective credit analysis that evaluates a company's credit worthiness, even the government's credit worthiness, and that credit rating is an alphanumeric score. We also have data services. A number of companies provide financial statement data in easy-to-download spreadsheet formats. And everybody that knows me well knows how much I feel Excel is important for as a business tool for these kinds of analytical exercises. All right, global accounting. I mentioned that generally accepted accounting principles are only applicable to United States companies, whereas the international financial standards are for the remaining company or countries in the world. The most visible difference is that many IFR-based balance sheets are presented in the reverse order of liquidity, where, of course, ours is in an increasing order of decreasing order of liquidity. The income statement, the most visible differences are the GAAP requires 3 years of data on the income statement, whereas the IFRS only requires 2. We can easily, IFRS firms can classify their expenses by function, cost of sales, sales general and administrative, research and development, etc., or by type, raw materials, labor, depreciation, etc. All right, so that ends our last video, and when we come back, we will continue with Chapter 3. Until that time, bye for now.